Hello, fellow investors. Welcome to another episode of Ritter on Real Estate, where we teach you how to passively invest like a pro. Today, I've got a very good friend of mine, fellow investor, John Casmon. John is a real estate entrepreneur who's partnered with busy professionals to invest in over $145 million worth of apartments. He's the host of the Multifamily Insights podcast, which I've been on. You guys should check it out. It's a great show. And he's a co-creator of the Midwest Real Estate Networking Summit. John is now a full-time investor, but before that, I know he was in the corporate America, leading marketing for General Motors, Nike, Coors Light, bunch of great brands, right? So John's got great experience on the corporate side and on the investing side now. And so, John, thanks so much for being on the show today.
Hey, Kent, thanks for having me. It's great to see you and great to chat with you and all your listeners.
Yeah, John and I have known each other for a long time now. I don't know how many years, probably 6 or so. John and I have invested in some deals together. We've got a really special treat for you guys today because we're actually going to look at one of those deals and talk about it a little bit. It's a deal that John was really running point on. We'll talk about that as a little case study on what can go well in multifamily and how you do well in a syndication and how you get how you meet your pro formas, right? And do what you promise you're going to do. So really excited to dig into that content. There's going to be some good nuggets for you guys. Before we do that though, John, tell folks or remind folks, who are you and how'd you get to where you are today?
Yeah, I mean, like many of your listeners, I was in corporate America for 15 years. I was working in marketing and advertising, and I enjoyed what I was doing. I really did. I had fun creating campaigns. The challenge for me was I was working in the corporate environment, and sometimes when you're in that environment, you don't get to control the outcome. And that's exactly what happened. I worked at General Motors when we went through bankruptcy. So I experienced that firsthand and watched a lot of my peers kind of get let go or shipped around a little bit and realized that's not the life I wanted. So I tried to learn how I could take more control. Real estate was a vehicle I kept reading about. So started to learn how to invest. Ultimately ended up moving to Chicago, bought a couple smaller properties, started to scale up that portfolio while working at an agency. And I actually ended up going bankrupt at that agency as well. So that agency had some hardships, ended up closing its doors completely. And it was at that moment where I realized, I'm investing in real estate. It's working kinda, right? I'm building some equity. I got a little bit of cash flow, but it hasn't given me the financial freedom I thought it was supposed to give me. And that's when I realized there are different strategies to investing. And I came across this notion of syndication. From there, learned all I could, hired a coach, started really learning more about the syndication world and started to do some investments. We started scaling up, did 192 units out in San Antonio, Texas, did a 28 unit in Cincinnati, started doing more deals in the Midwest. And as you mentioned in my bio, today we've done about $150 million worth of apartments and looking to scale that today.
Yeah, I love that. I mean, the impermanence of corporate employment, right? I think people often think, man, I've got this job, like I'm super safe, not realizing you could be one bad quarter away from needing a plan B, right? Luckily for you, you had started to build that plan B. And so you had, it sounded like somewhat of a safety net. You had to grow into it, but at least you had a path forward in real estate, right?
Yeah, and I think it helps, right? At least to know where you're headed, to know what you're going to do, because panic sets in, right? And when you get that call, it's frightening for a lot of people, especially if you didn't have a plan B. And for me, I was early in my career when it happened at GM. I was in my early to mid 20s. So when that happened, it was just me. I could always just pack up, put my stuff in a suitcase and bounce around if I wanted to. And I didn't lose my job at that point, but I had to come to the realization that this is corporate life. It's cutthroat. You could just be not someone's guy and they ship you off or let you go just because you don't have that relationship. It's not about just doing a great job. It is about networking and politics and all those different things. And I think that experience early on kind of led me to say, hey, you need to have a plan B. And part of it was, I remember during that time, everybody was stressed out except one dude. There was one guy who came to work every day with a smile on his face and a little pep in his step. And I didn't understand it. I'm like, dude, everybody here is stressed out completely. And you're like just walking around like life is peachy. And we started chatting more and more. You know, he was a coffee drinker. I wasn't, but I would walk with him to get coffee and just chat with him. And he told me he was investing in real estate and had been for the last 15, 20 years. And he worked there because he enjoyed his work, not because he needed the money. And I think that was the first time that seed was really planted. It was like, like you can see, like, I know there are people who made more money salary wise than him at that job, but they didn't look happy. And Jack did, right? Yeah. So that was the moment I think I started to say, okay, I really need to think about this real estate thing more. And you're right, you know, having that plan B, and sometimes you have to grow into it, but at least understanding what you're going to do, that takes some of that anxiety away and empowers you to take control of your life.
Mm-hmm. And I mean, I love that story of Jack. I mean, just thinking about that shift of what I've experienced in my life. And I would imagine what 99% of people that are working experience, right? You're working because you need that money, you know, and you've got that stress of, well, what happens if I lose my job, right? I mean, that it's not there, but imagine that mindset flip of doing what you're doing because you just enjoy what you're doing, right? You don't have to do it. And I can imagine why he's walking around with a smile on his face. So I just think that's an incredible example of the power of having multiple income streams, right? Doesn't really matter what it is, but having that passive income where it allows you to focus your time on what you love, not on, you know, toiling and trading your hours for dollars in a job that you don't love. So that's a super cool story, and hopefully something people can grab onto a little bit.
Yeah, absolutely. And I think too, like, that's the thing with real estate that's so powerful is, you know, for those folks who are busy professionals, maybe you don't have the time to go out there and learn everything there is to learn about being a successful investor. But that's why there's great passive investing opportunities through syndications, private lending. There's so many different strategies. But you don't have to just say, oh, that's good for them, but not for me. No, it could be great for you too. You just have to learn the right strategies and then connect with the right people to learn how to implement it.
Absolutely. Absolutely. So John, let's jump into this case study because I'm excited to talk about this. So John, back in Rewind 2021, right? John and I made an investment, you know, through syndication with our investors into a deal in Louisville, Kentucky. And, you know, it's gone pretty well. And you don't hear that a lot these days. And so I thought it would be really cool for you, John, to be able to tell people about, you know, starting with what attracted you to the deal in the first place, right? Why did we like that deal? I could share my own perspective. And then, but I think interesting we hear a lot about deals that bought in that time maybe haven't gone so well. So what was the differences there? What were the things that you saw, and how were you building in kind of those protections along the way to get us to where we are today, which is sitting in a pretty good spot? So just love to hear you expand on that. But just start with, you know, tell us about the deal, tell us the details, and then tell us about what was it that really attracted you to that deal in 2021?
Well, I think the first thing is understanding what to look for in value. I think very often when we think about value and value add deals, we're thinking about interior renovations, right? Going in, fixing up the kitchens, fixing up the bathroom, new paint, new flooring, new light fixtures. And we're going to invest $5,000, $10,000 into a unit. And we're going to be able to charge $200, $300 more rent. And that's where we're creating value. But that is not the only way to create value. And this deal is a great example of that. So this was a newer construction project built in 2019. We bought this in 2021. So just 2 years after, you know, final construction. And we got it directly from the developer. And that really was very intriguing because typically speaking, developers like to develop, not manage. So once it's up and constructed, they'll fill it up, but they're not necessarily designed to have all the operating systems, the processes, procedures to maximize rents, maximize income, lower all the expenses. That's not their preference, right? They've already built it. They've already made most of their money, or they're trying to exit so they can make most of their money once it's stabilized. So we like that aspect of it. This was coming, you know, kind of on the tail end of COVID. So there were still a bunch of COVID restrictions in place. And as we looked into the property more, we recognized that there were some opportunities that the current ownership wasn't taking advantage of. But I think the biggest thing for us was this was a newer property, which meant we would have lower renovation costs. We'd have lower maintenance costs. And it was really hard to find B-class new properties. And I was always really intrigued with that aspect. Typically, when you're looking at newer stuff, you're looking at luxury, A-class. This is a nice property, but it was still somewhat affordable for that B-class tenant. And I thought that allowed it to stand out with the cost of construction shooting up. And I didn't think there would be a lot of competition for a project like this. As we looked at all those different factors, we just felt that this was a good opportunity to create value. The other thing that I would say is when we think about value add, because most people think or go straight to, well, what work can I do? The physical work of it and not necessarily the operational work. I think this was missed over. A lot of groups passed on this deal, didn't really underwrite the deal. As a matter of fact, one of our other partners, she found the deal, analyzed it, brought it to me and said, hey, I think this is a great opportunity. And I initially looked at it and was like, well, what are we going to do? Like, I don't see what we do here. And as I looked at the numbers more and understood the story and toward it, it became really, really clear that, oh, okay, this is more of an operational play. So I think part of it is just really being able to find an opportunity that others are going to overlook for various reasons. And that really gave us a chance to find a deal, create value, and deliver strong returns to our investors.
Yeah, I mean, I love that aspect of, so you talked about just vintage, right? It was newer property you talked about, but it was unique in that it was newer, but it was really kind of that B class, right? So you weren't going top of the market luxury rents. Rents were still very affordable. And we felt like there was a little room to even move there. And then there was opportunity on the expense side. And most of it was driven by operational improvements rather than physically changing the asset, right? So a new way to create value. The other thing that I always liked about it was the debt, right? And even back in 2021, which feels like a totally different world right now, I still was like, man, this is sweet debt. So tell us a little bit about like the debt and why that's worked out so well with how the world has changed over the past 4 years.
Yeah, I mean, the debt was amazing, right? So we ended up getting this thing. It had a 12-year fixed 3.21% interest rate on it. So we assumed that debt. And that was amazing because it really lowered our risk. You know, with 12 years fixed at 3.21%, our cost of capital was very low even at that time. It seems, crazy in today's world to think we got a 3.21% interest rate. But that's what we were able to get. And ultimately, I think you have to step back and look at a business plan in its totality. I know you and I were talking about, other projects purchased in that time frame. And a lot of folks are saying, hey, if you bought in 2021, those deals aren't working. Well, that's not the case. You have to understand the entire story and the business plan. And for us, it really comes down to pairing the business plan with the right loan product and making sure that it makes sense. And in our case, on the one hand, I just told you we weren't doing a whole lot to force appreciation, right? There's certainly some operational things we're going to do, but it's not like we were going in and gut rehabbing the units. So because we weren't doing as much hard work on the rehabs or the construction, you really want to balance and offset that with the loan product from a risk profile, right? If I'm not going to do that much heavy lift, I want a loan product that is really stable and fixed, right? If I were doing a heavier lift, then I'm probably more comfortable having a loan product that's variable and shorter term. I think it's really important to make sure all of that is married together as you're thinking through the business plan. I think too often people they jump to these rule of thumbs of, hey, we don't want to do any fixed debt. And I mean, you and I were joking about that before, right? But it's not the fixed debt that's the problem. A lot of times it's, well, what's the business plan and what are the different areas and the different components of what could happen? And when you pull it all together, that's where you have to identify the right plan. If I could give you an example real quick, the very first syndication deal I did, it was 192 units in San Antonio. I had partners that I worked with. We were very concerned with the state of interest rates. So we locked in our rate for 7 years. I believe it was like a 5.6% interest rate back then. Well, shortly after, rates kept dropping, right? They were down to the low fives, then the high fours, then the low fours. And we were sitting there with this, 7-year fixed rate debt because we wanted to be quote unquote safe. And we actually couldn't sell or exit the deal, even though we had great offers from prospective buyers because of the prepayment penalty. It was too high.
Yeah.
And
yeah.
that is the kind of thing you start to learn is like, you have to look at everything in totality because that prepayment penalty, I mean, I think it was like a few $100,000 when you run the numbers on it. And that's something you don't typically factor in. So when we think about risk and the right loan product, you have to look at all of these different factors to make sure you are creating the right business plan for that particular project. And I think we did a really good job of that one on our Louisville deal.
Yeah, absolutely. And I love that comment of matching the type of debt to the business plan, right? And making sure those things fit. And those things are accretive to each other, right? And I think that's worked out really well. So tell us a little bit about, so that's why we like the deal. You saw this opportunity on the management, the upside, the market. We had low risk because of just low debt, right? We knew it was fixed. Talk about as, we got into the property. I mean, what did you find? What was what you thought it would be? What was different than what you thought it would be? And then kind of from there, how did you adjust and kind of give us a story of like where it's gone?
Well, I think from an operational standpoint, I thought it would be easier to implement our plan and push rents and kind of turn things around. We had a little bit of an issue the first 6 to 9 months, particularly with collections and delinquency. It was more challenging than we anticipated. And some of it was due to the COVID restrictions and, what was happening, and we didn't really think through it at that time. It became evident down the road. A lot of residents were playing a game, right? They had to be late on their rent in order for these government assistance and these programs to come in and subsidize them. So they were deliberately not paying, even though they had the rent. They had the money to pay us. They deliberately didn't pay so they could go and be delinquent, wait for an eviction to be filed, and then they could apply for these different programs to come in and give them money. And it was a game that a lot of them were playing. So that took, it took maybe 6 months to figure out that was indeed what was happening, and not just with one resident, but multiple residents. And we had to change our entire policy to say, you know what? Listen, we're not doing those games. If you fall here one time, we will honor whatever we need to do from a legal perspective. But when it comes time for renewal, when it comes time for, rent increases and things like that, we're going to have a different tune. And we strongly encourage them to, if you can pay your rent, pay your rent. If you're in a serious hardship, that's different. Like, let's have a different conversation. But if you are just gaming the system, listen, I understand, but on the same note, we can't have our financials impacted based on these things that are outside of our control. So I think that was just a big shock, was just, the things that were completely out of our control from that standpoint. When it was going on, we would sit down with those residents and help them with their applications for those who actually needed it. So we'd bring them into the office and sit down and make sure those things got sent off properly. But we had to be very, very proactive in collecting rents and driving that delinquency down. I remember at one point it was maybe around the 8 or 9% range. We got it down under 5%. We got under 2%. And there are months now where we have that collection. It's that, collections itself is at like 99.5%. We've had a month where I think there was like $40 that we didn't collect. So, I mean, we've had some really, really outstanding performance when it comes to collections based on being proactive.
Yeah, that's so interesting to think about, because I forget about that. I mean, just kind of 4 short years ago, and all the things that were going on with all the free money and programs during COVID, right? And there were a lot of games to be played and ways to go about it. But the point, I think, is that in these deals, right, like nothing is going to go as expected. These are typically 5-year holds, right? You can't expect in 5 years for everything to go as you planned. And the important thing, I think, about a great operator, a great sponsor is, as you said, being proactive and being able to pivot and being able to come up with a new plan, right? And being able to adapt. And I think that's what's so critical. I think that's what makes good operators different from bad operators, right? And people that just say, oh, business plan didn't go well. Oh no, right? Versus you just got to go in expecting stuff's going to go sideways, and you got to have contingency plans in place, and you got to have the team there to support you in that, and to have those ideas and come up with those processes. Right. And so I think that's a great example of just like nothing's ever going to go exactly like you think it is.
And Kent, to your point, I mean, there are a lot of things that just change, right? We go in with our business plan. We have experts that we consult with, but when you get into it, once it's live and things change. And I remember one other thing that really surprised me was the tax reassessment. We got a tax reassessment, and we sat down, and again, because this was a project from the developer, the taxes that they were paying was a much smaller number than what we had anticipated. But we ran all of our numbers. We kind of all agreed with the property management company, all of our partners, our attorneys. We all kind of aligned on where we thought the taxes would be. And we had a range of about maybe $10,000, right? Where on the low end, it was, let's call it $95,000. On the high end, it was about $105,000. Well, when that tax bill came in, it was about $30,000 more than that. And it surprised me because we had consulted all these experts, and they kind of laid it on and say, hey, here's what happens in Kentucky, and here's what you can expect. And it came in $30,000 higher than the highest estimate we got from anybody that we consulted with. So that was a lesson as well. Just obviously when you're working in different markets, this was our first deal in that market in Louisville. So for us, part of the lesson was, yes, we had talked to our consultants and our advisors, but we should have, I would say moving forward, processes, we're going directly to the tax professional to get that estimate. I want it in writing, because that maybe something changed where the millage rate changed, and I'm not sure what exactly happened still, but either way, that's one of the things that I think we learned from. But then it's to your point as an operator, okay, this happened. How do you combat that? And it's taking a look at our business plan and recognizing, well, what other adjustments can we make to offset this? At one point, we had planned on investing money. I think we had about $40,000 in the budget to invest, or about $50,000 in the budget to invest in washer and dryers. Well, we looked at it. That was going to give us about a $50 a month rent increase. We said, okay, is it worth it to do that? Or is there other ways we could get this rent increase? So instead of doing the washer and dryers, we actually put in backsplashes. The backsplashes were a fraction of the price, but it gave us a very similar rent bump that we were looking for. So we did that instead. So I think to your point, something's going to happen. It's just like in the business world. And this is why I think it's great for folks who come from other business or other industries, because it's the same thing, right? Like you have a budget for an ad campaign. All right, well, if your budget gets cut, now what? You just put your hands up and say, oh, guys, sorry. Well, guess we're not selling vehicles this year. No, you got to figure it out. So it's the same thing, right?
Right.
We had a situation, obviously our tax bill got a little bit higher. We had to look at our overall budget and say, okay, guys, how do we make this up? Maybe we can't make it up in one fell swoop, but, can I make another $5,000 here? Can I make $7,000 here? Can I cut $3,000 here? And you try to ultimately get to the place where you're back to a balanced budget sheet based on what you had in your projections. And for us, the good thing was we had a strong product. We were in a strong submarket, and we were able to increase and actually overshoot what we had in our rental income projection. So because of that, we're able to fairly quickly make up for that increase in expense. But it really came down to also being conservative in our initial underwriting, right? We didn't factor in $300 rent bumps. We factored, I think, $50 or $75 rent bumps. So when you're able to exceed that, it makes it a little bit easier to kind of catch up and get things back on a balanced board.
Yeah, you said a couple of great things there I wanted to hit on. So one is, and this, I had have a mentor who told me one time, your pro forma is always wrong. He goes, it's either going to be wrong to the bad side or wrong to the good side. But I mean, it's all just an educated guess, right? I mean, you're never going to hit it dead on. And so just as you said, it's all about how you adjust during that time. And the way I think about it is you got to have multiple ways to win. Like if your whole business plan is based off of, for example, raising rents $300 and you've got nothing from expense reduction or other income or different ways, right, to get there, then you're probably not going to be successful, right? You got to have a lot of different ways to win. It sounded like in this deal, you had a lot of different ways that you could still come out, right? Okay, taxes were higher, but we had been conservative on our rent and we were able to actually go above and beyond, right? And actually offset that, right? And you were able to do, like, I love the switch from washer and dryer to, man, a backsplash. And you can get a solid rent bump because we were so competitive in the market. And that was part of the upfront analysis, right? On like, us versus the comps, there's a lot of room to move here, but you didn't come out and tell people, hey guys, we're going to get $300 and we're going to get you a 20 IRR, right? You were able to temper expectations and say, hey, we only need to get maybe 75. And so now it looks like you're winning instead of, the other way around, and how that could be flipped on just a perception standpoint. So I know kind of summarized a lot there, but I just love that idea of had a lot of different ways to win, a lot of different levers to pull. And that ultimately, as some things went sideways, you were able to win out in aggregate, which is, I think, what we're trying to do at the end of the day, right?
Yeah, that's exactly it, Ken. And I think the other thing too is we had a high floor. And I don't think enough can be said about investing where you're cash flowing out of the gate and maybe not delivering on a 7 or 8% pref return out of the gate, but you're making money out of the gate. It's a lot easier to play and to operate when the property is generating enough income to cover all of the bills and the debt service and generate some profit versus when you're coming in and maybe the property is negative cash flow, or you have to invest, again, $10, $15, $20,000 into each unit to try to get this thing to deliver profits for investors. That becomes a lot harder. So when you have that high floor, it makes it a little bit easier to execute. And when we talk about deals, I know for me, the thing I loved was it was a newer asset, high floor, especially based on the debt that we had. And we had a pretty good upside as well. So when you combine that, to me, it's risk adjusted returns. And to your point, yeah, it's not the 20, 25% IRR, but on the same note, I felt like it was a great investment opportunity for investors. And really excited that we were able to, go out there and execute on that plan.
Yeah, absolutely. And, one thing you mentioned as well was a big part of the business plan was related to management, right? And the operational improvements that could be brought from bringing in best practices versus what was happening. And so talk a little bit about kind of how you were able to do that, how you manage that relationship. Because I think, in my mind, management is probably the most important thing, day to day on an asset. I mean, they can really make or break. And so how did you set up that plan, guide the management company, set expectations, and really drive those operational efficiencies?
Well, as you know, management's a challenge, right? It's always a challenge. And every operator you speak to, they're going to have some challenges with management. And that's been the case here as well. What I would say, though, is that, what I learned on this project in particular is that on-site PM is absolutely critical. You want the management company and kind of their leadership to be strong and supportive. And obviously that's really important too. But that on-site PM, they're the ones that's interfacing with your clients every day. They're talking to the residents, they're interacting with the vendors, they're talking to the maintenance techs. So if you can get the right on-site PM, it makes your life a lot easier. Yes, we want them to have the systems and processes and back-end support and, technology and all of those things to make their job easier. But you got to get the right person. And I think what ends up happening often is you have a property, things are going well, maybe leasing is slow or whatever it is, right? Just something's off. And our natural reaction is to look to make a correction, to make a change. And I would advise people, before you do that, ask yourself this: is the issue a process issue? Is it a people issue? Or is it a partnership issue? All right. Which P is it? Because if it's a process issue, that could mean maybe you didn't just lay out what the procedure needs to be. And I'll give you an example here. How do you lease a unit? Literally, what are the steps from the time a resident gives notice to the time the unit is moved in by a new resident? What are the steps? Not every property management company has this detailed. Not every step. We all know to walk the unit when they move out, to fix up or turn the unit and to show the unit. But what are those steps? Do they have metrics for how many applications, how many days that it takes to turn a unit? Do they have a checklist for turning the unit and walking the unit when they clean it? Like, you would be amazed at how many companies don't, even if they have the checklist, do they follow them? A lot of companies have all these rules and procedures and no one follows them. So it doesn't help. So just understanding those things is absolutely critical, because you'll get into conversations and realize, either we don't have the process or we're not following the process. So you got to figure out, is it a process issue? I love that, because if it's a process issue, that's the easiest thing to fix. If you've changed the process, or there's a process and it's not being followed, well, now we got to move on to, is it a people issue? Do you have the right PM? Do you have the right maintenance tech? Do you have the right people on the team? Because maybe you don't. Maybe this person isn't following up. They're not returning those phone calls. They're not friendly. They're not inviting. They're not, the person you want representing the company when they're interacting with these clients and these residents. So now you have to make a change at the people level. And then if you have the right people, you have the right processes, but you're still not getting the results, well, now you got to look at the partner, and that's up at the property management company. Because the truth is, property management companies, they're different entities. They have their own P&Ls. They have their own different ways of making money. And at a lot, quite frankly, they're at odds with us. They make money from us, and their job and the way they make money usually isn't aligned with maximizing our money. So I found this out on a different property down the road, where our PM company was almost directly telling people, don't worry about doing that for this project. Focus your efforts over here. So they're literally telling people, we pay on this property not to prioritize the stuff that we're talking about. So it wasn't the people, it was the company. They had a completely different alignment of interest, because that project that I'm referencing was a little too small for them. And instead of telling us that and allowing us to walk away as partners, they just decided to prioritize something that was more monetarily feasible for them. So it's you have to recognize that sometimes your interests just aren't aligned, and you don't have the right partner. They don't have the right mindset. They don't think the way you think. They don't see value the way you see value. They may want to prioritize pushing market rates. You may want to prioritize occupancy. Like, these are things you have to sit down and talk about, because if they don't have your KPIs, if they don't know what success looks like for you, then they're just going to fill in the gaps. And you don't want that. You want to make it really clear of what success looks like to you. What are your KPIs? What should they be trying to achieve, so that they understand how to make decisions? Because if not, they could be doing a whole bunch of discounts to move people in. They could be lowering credit score, restrictions just to get it, get the units filled. Because for a PM, usually they're thinking that they don't want to have a bunch of vacant units. So they want to do whatever it takes to get those units filled. That's just how they're wired. Some will be uncomfortable if a unit's vacant for 2, 3, 4 weeks, right? And we are, as operators, we're trying to maximize cash flow. We're trying to maximize the value of that unit. And there are nuances of how you do that. But again, that resident is just seeing, or that the PM is just seeing a vacant unit. They want to get it filled. We're looking at it and say, if you sign the wrong contract today, then that's hundreds, if not thousands of dollars that I have to forego for a year before I can try to get that revenue generating unit optimized again. So they don't necessarily understand that. They're not necessarily the business owner. They're not the person who's thinking from a technical or financial standpoint like that. So you have to reconcile that to make sure that they understand the KPIs. But again, it comes back to process, people, partner. When you have those issues, try to identify at what level that issue resides, so that you can get it solved.
Yeah, I love that. I mean, my takeaway is, one, you've got to be in the weeds with the management company, right? I mean, clearly you were in the details, understanding what was going on, understanding the metrics, providing clear guidance. I like what you said. What does success mean to you? Right? Giving them a clear picture on what is success. You hit on kind of these competing factors of, the easiest thing in the world is to not raise rents and keep occupancy high, right? I mean, everybody's going to kind of move toward that.
And spend more marketing, right? We need to spend more marketing.
Yeah. If you're not constantly redirecting, right? And putting the guardrails up and kind of redirecting and keeping people on the right path. And I think especially with third party management, man, it's a constant process, right? Of redirecting, incentivizing good behavior and trying to squelch bad behavior. So I think the effective management to being in the weeds, understanding the numbers, being alongside with them, setting the right expectations. I think all of that is why, from a management standpoint, we were able to have wins on the operational side on this project. And so I think all that really well said. So John, now we're 4 years in. We're looking at what could either be, a few different options on how we go, but we're well positioned. We're cash flowing. Maybe we exit, maybe we don't. Maybe we add a supplemental, maybe we do. But we've got options because the property's in a really good spot. Because again, going back to the beginning, right, of all this on what set it up, right? First of all, it was in a good market. It was in a good submarket. It was a good product, right? It was a new build where we knew that there was rent upside, right? We knew there were management inefficiencies. We aligned the debt with that business plan, right? Getting that low debt, long-term debt that really laid off the risk, where we didn't have to increase risk by really making these wild, big projections, right? And in that way, you were able to overachieve on where rents actually ended up and how things actually turned out, which ends up with a bunch of happy investors. And so it's a fun case study to talk about, right? So I think really cool to see the evolution of this project. Really cool to hear that projects from 2021 can in fact be successful if you align them in the right way. And a lot of it has to do with debt, right? I'll be the first to admit that. Yeah, John, thanks for sharing that story with us. I think it is really insightful for folks to take some key nuggets away on what they should be looking for as they think about their next investments.
Yeah, absolutely. And you're right. We didn't talk as much about the market, but I think the one other thing I would add is when you think about the market, make sure you understand the supply story, because, new supply, debt, those are the two things that are driving a lot in the multifamily space. But again, if you read the national headlines, it can be misleading. New supply in many of the Midwest markets is not the same as it is in some of the coastal and southeast regions. So when you think about that supply, what type of asset are you thinking about? Is it A-class new supply? What neighborhoods? Is the population growth? Is the demand there to meet the supply needs? So you really want to pay attention to absorption rates. So there's some markets where there's a lot of new supply, but their properties are being absorbed. So it's fine. It's no issue. But when you have high debt, when you have job loss or jobs that are cutting, pulling some back, or maybe pulling back on development and growth, that's where it starts to be an issue. So again, throughout the Midwest, if you look right now where the rent growth numbers are, the Midwest and actually the Northeast are leading the charge, because those markets have seen really good absorption. They're seeing solid development, but not outpacing what the demand is. And ultimately, when you walk away from all of this stuff and all the technical things, it really just comes down to supply and demand. We know that we have a housing shortage, particularly when it comes to affordable housing. So when you look at the supply that's coming online and look at the markets where it's coming online, you really want to make sure that that supply has enough demand to be absorbed and that your business plan has room to be successful. And I think we've done a pretty good job of that. And that's kind of our outlook on the market in general.
Yeah, I think, right, the headline is never the whole story, and real estate is always very localized, right? So you gotta, like, as you said, I mean, what's happening in the Midwest is very different than what's happening in other parts of the country. And so folks have to just look below the headlines and they got to dig a little for the real story. I appreciate that. One of my favorite economists, a guy named Peter Linneman, who follows commercial real estate. And I remember he was being interviewed and he gave this example of, like, they were talking about supply and demand. And his comment was, I would take Cincinnati over Denver any day. And his reasoning was Denver, high growth, but really high supply market. So everybody's moving there. Jobs are coming there. And because of that, people are building a ton of units. He said, versus Cincinnati, which is not a sleepy place by any means, but just growth wasn't as high. So, and new supply was almost non-existent. And he said, I'd rather take that any day over an investment in Denver. And I just thought that was such a good way to hit home that whole point that like that supply side is the big risk. And being in a market that is oversupplied, meaning people have to give discounts to get people to move in, is going to be direct competition against you and your business plan. And so really paying attention to that. I appreciate you bringing that up.
Yeah, absolutely. That's so key and fundamental. Yep.
So John, before I let you go, I want to take you through our keys to success round. I got 4 questions I want to ask you. The first one is, if you were going to make a passive investment, right? You're on the other side of the table and you don't know anything about the deal. You don't know anything about the sponsor. You can only ask one question. What is the one question you would ask?
This is a great question. My one question I would ask is to tell me about a deal that didn't go according to plan. And when I ask that question, I'm listening for a couple of things. Hopefully they have something they can share. Deal doesn't have to necessarily be a complete failure, but just, we all know that deals don't go according to plan. I'm listening for ownership. How much ownership do they take on whatever happened with the deal? Are they blaming the market? Are they blaming their partners? Are they blaming, tenants? They blame their attorneys, or are they acknowledging, hey, here's what happened. Here's what, we learned from that. And here's how we've adjusted moving forward. I want to be with someone who learns from their mistakes and incorporates those lessons and grows as an investor.
I love that. And thanks for giving us the context around what we should be looking for from that answer. I think that's really valuable for people. What are you most proud of in your career?
Ooh, that's a great question. I would say we've never lost investor capital, and I hope to keep it that way the rest of my career. But, I believe we have a duty to serve investors, and I take that seriously. And, protecting their capital is a big part of that.
That's absolutely something to be very proud of. So congratulations. And what book should everybody read?
So many great books. Oh my goodness. I would start with Atomic Habits. I think it's just a phenomenal book. Who Not How is another great book that you should check out. And then last, 10X is easier than 2X. I think those are 3 really, really strong, very common, popular books, but really, really strong books if you're looking to grow, be more productive, and maybe develop yourself into the next version or a better version of what you want to be.
Yeah, those are all great books. And we'll make sure all those are linked below so you guys can check them out. And then, John, last question for you. What is your number one key to success?
That's a great question as well. The number one key to success for me is to be intentional. And it's writing down stuff. I've got my board up here with some of my longer term goals, my yearly goals. And just being intentional with the actions, intentional with what we do. I think that's really the key to success is it's got to be present. You got to remember it. You have to know what you're doing and why you're doing it. And it seems simple, but so many people don't do that. You want to be successful. You want to make money in real estate, and you never look at deals, or you never talk to investors, or you never put in offers, right? Like you have to be intentional with that and then map out kind of your game plan. So, if I can add on top of that, it's also taking action. So being intentional, but taking action, even when it seems scary. Hiring a mentor was scary for me, especially when I didn't have a whole lot of money to be paying a mentor, but I knew it was important to make that investment, right? To take that leap. And it's not a leap of faith. It's a leap in the right direction, because even if it doesn't work out as well as you wanted it to work out, you're still going to be closer to the goal that you set out for. So making sure you're taking action, you're being intentional. I think that's the biggest key to success.
Yeah, I love that, John. Appreciate all the value you brought today, and just appreciate you being a good partner, good friend, and for all the time we've known each other. As people probably want to, get to know you, learn more about you, how can folks reach out?
Yeah, you mentioned the podcast earlier. So I host a podcast called Multifamily Insights. It's a number 1 rated podcast. We got over 700 episodes. So check that out anywhere you listen to podcasts. And I also have a free gift for your listeners. So you asked me the question I would ask as an LP. I actually put together a free guide. It's 7 questions you should ask before investing in apartments. So if your listeners want to check that out, they can go to casmoncapital.com/7 questions. And we cover, a few different things, but it gives you kind of a framework of 7 key questions you should ask before investing.
John, I'm going to say I appreciate that it's 7 questions, not 100 questions. I've seen some of these sheets. So 7 key questions is great. I recommend everybody check that out. It'll all be linked in the show notes, so you guys can grab that. John, thanks for coming on today. Thanks for adding so much value. Thanks for being a good friend. And I hope you have a great rest of the day.
Thank you, Ken. I appreciate it. Thanks for having me today.